You know, I've been watching something unfold over the past few weeks that frankly has kept me awake at night. And I don't say that lightly. At my age, you learn to sleep through most things. Markets rise, markets fall. Politicians argue, headlines scream. That's all part of the rhythm. But every so often, something different appears. Not a headline, not a scandal, a pattern. And when a real pattern starts to form, one that suggests something fundamental is shifting beneath the surface, that's when experience matters. That's when you stop listening to the noise and start paying attention to the structure. 1 minute ago, the headline crossed the wires. A major long-term investor has exited U.S. positions tied to Canada-U.S. trade. On its own, that might not sound alarming. Markets move every day. Capital reallocates constantly. But what matters isn't the move. It's the reason behind it. I don't make decisions like that on impulse. I've spent more than 70 years building a reputation on patience, on restraint, on holding quality assets through storms that felt unbearable at the time but proved temporary in hindsight. So when I exit long-held positions, assets owned for years, sometimes decades, it isn't because I'm nervous. It's because the underlying assumptions have changed. And that should concern anyone who cares about economic stability, about the future of North American commerce, about whether the systems built over generations can withstand the pressure they're under right now. Let me be clear from the beginning. This is not about politics in the narrow sense. It's not about parties, personalities, or elections. This is about how economies actually function. It's about how trust is built between nations, how trade relationships create value, and how quickly that value can be destroyed when predictability disappears. What I'm seeing in the relationship between the United States and Canada right now is one of the most dangerous economic developments I've witnessed in my lifetime. Not the loudest, not the most dramatic, but one of the most corrosive, because this kind of risk doesn't arrive with sirens. It doesn't crash markets overnight. It seeps quietly into supply chains, investment decisions, and long-term planning. And by the time most people realize what's happening, the damage has already been done. To understand why this matters, you first need to understand what this relationship actually is. The United States and Canada aren't just neighbors. They aren't simply friendly countries that happen to share a long border. They are economically integrated. Every single day, roughly $2 billion worth of goods crosses that border. Not tourism, not luxury trade, essential goods, industrial components, energy, agricultural products, pharmaceuticals, technology inputs. Automotive parts cross the border multiple times before a single vehicle is finished. Energy flows south to power American homes and factories. Supply chains don't stop at customs checkpoints. They depend on the border being predictable, boring, invisible. For decades, that's exactly what it was. Through Republican administrations and Democratic ones, through booms, recessions, crises, and recoveries, through disagreements and negotiations. The Canada-U.S. trade relationship remained one of the most reliable constants in global commerce. Not because of sentiment, not because of friendship, but because it worked. Both sides benefited, both sides prospered. That's how trade is supposed to function when it's done correctly, not as a zero-sum contest, but as a positive-sum system where efficiency creates shared wealth. And now, that system is quietly coming apart. Not all at once, not officially, but structurally. Over the past several months, a series of policy decisions have fundamentally altered the operating environment. Tariffs that didn't exist before, regulatory barriers that introduce friction where none existed, threats and counter-threats that inject uncertainty into every cross-border transaction. And the rationale changes constantly. One day it's national security, the next it's protecting domestic workers, then it's leverage for unrelated negotiations. But regardless of the justification, the effect is always the same. Higher costs, lower predictability, greater risk. And risk, when it reaches a certain level, forces action. That's where this story really begins. Here's how I think about risk, and this distinction matters more than most people realize. There are two kinds of risk in investing. The first is measurable risk. That's the kind you can model. You can estimate probabilities, run scenarios, hedge exposure. Interest rates go up, demand slows, costs increase. Those things are uncomfortable, but they're manageable. Entire careers are built around pricing that kind of risk. The second kind is something very different. It's fundamental uncertainty. That's when the rules themselves are no longer stable. When you don't just face bad outcomes, you face unknown ones. When yesterday's assumptions can be invalidated overnight by a policy shift, a regulatory reinterpretation, or a political calculation that has nothing to do with economics. Measured risk can be absorbed. Fundamental uncertainty cannot. And what's happening right now in US-Canada trade has crossed that line. Businesses can adapt to higher costs. They can adapt to new regulations. They can even adapt to tariffs if they believe those tariffs will persist and can be planned around. What businesses cannot adapt to is not knowing what the rules will be next quarter. That's the environment we're in now. Companies with cross-border supply chains are suddenly forced to ask questions they've never had to ask before. Will these tariffs still exist in 6 months? Will new ones be announced without warning? Will regulatory approvals be delayed for political reasons? Will retaliation escalate and spill into unrelated sectors? These aren't theoretical questions. They directly affect whether factories get built, whether infrastructure gets financed, whether capital gets deployed at all. And when uncertainty reaches that level, the rational response isn't expansion, it's hesitation. That's what worries me most, because hesitation doesn't make headlines. It doesn't show up as a crisis. It shows up as projects that quietly never happen, jobs that are never created, investments that are deferred indefinitely. Now, I understand why these policies are popular in some circles. They sound decisive, they sound tough, they promise protection. But economics doesn't care about rhetoric. It cares about incentives and consequences. Let me give you a simple, concrete example. A tariff placed on Canadian steel may appear to protect domestic steel producers. And yes, in the short term, some producers benefit. Their products become more competitive as imports grow more expensive. But steel is not an end product, it's an input. It goes into cars, buildings, machinery, appliances, into nearly every sector of the modern economy. So when you impose a tariff, you don't just raise the price of steel, you raise the cost structure of every downstream industry that depends on it. Automakers pay more, construction firms pay more, manufacturers pay more, and those costs eventually flow through to consumers or force companies to cut elsewhere, often in wages or employment. And then comes the second-order effect. Canada doesn't simply accept the tariff, no sovereign country can, so they respond. Retaliatory tariffs, targeted restrictions, political signaling aimed at domestic audiences. Suddenly, American farmers lose access to Canadian markets. Exporters face barriers that didn't exist before. Entire regions feel the impact. This isn't theory, it's arithmetic. Both sides lose. That's what economists call a negative-sum outcome, where friction destroys value instead of redistributing it. And the most dangerous part? The damage compounds quietly over time. Supply chains become less efficient. Capital becomes more cautious. Growth slows not because of a single event, but because the system itself becomes less trustworthy. I've seen this before, not just between nations, but between businesses. When trust erodes in a long-standing partnership, everything changes. Contracts become defensive. Collaboration disappears. Everyone starts protecting themselves instead of creating value. That's exactly what's happening now, at a national scale. What makes this situation especially troubling is that the framework for cooperation already exists. The USMCA agreement was signed only a few years ago. It replaced NAFTA. It was negotiated, celebrated, and marketed as a stable foundation for North American trade, and in many ways, it was. It modernized digital trade rules, strengthened labor standards, updated environmental provisions. It gave businesses something they value above almost everything else: predictability. But instead of building on that foundation, current policy is quietly hollowing it out, not by tearing it up outright. That would be too obvious, too politically costly, but by layering unilateral actions on top of it: tariffs, regulatory friction, enforcement asymmetry, technically legal perhaps, economically corrosive absolutely. Trust doesn't collapse all at once, it erodes. And once it's gone, everything becomes more expensive. financially and politically. This is the moment when long-term investors stop asking, "Is this business strong?" and start asking, "Can this environment be trusted?" For me, that question has already been answered. There's a misunderstanding about long-term investors that I've encountered my entire career. People assume that because we hold assets for decades, we must be indifferent to risk, that we simply buy, sit still, and ignore what's happening around us. The truth is the opposite. Long-term capital is extremely risk-averse, just in a different way. We're not afraid of volatility. Prices move, markets fluctuate, that's noise. What we're afraid of is permanent capital loss. Situations where the underlying value of a business is destroyed by forces entirely outside of management's control. And that's exactly the kind of risk that emerges when policy instability becomes structural. For decades, businesses operating across the US-Canada border relied on a simple assumption that the basic framework of trade would remain stable enough to plan around. Not perfect, not frictionless, but predictable. That assumption is no longer safe. Over the past several months, I've been quietly and methodically reducing exposure to companies whose business models depend heavily on cross-border stability between the United States and Canada. Not all at once, not dramatically, no panic, just disciplined risk management. These were not speculative positions. These were high-quality businesses, strong balance sheets, competent management, durable competitive advantages. The kinds of companies I normally prefer to own indefinitely: energy infrastructure, transportation networks, manufacturers with integrated operations on both sides of the border. These businesses function only when permits are honored, regulations are consistent, and governments treat infrastructure as long-term commitments rather than political leverage. And that's precisely what has changed. Permits that once moved quietly through administrative processes are now subject to political pressure. Regulatory approvals are no longer routine, they're contested. Trade flows that operated smoothly for generations are suddenly vulnerable to disruption. That kind of environment doesn't just increase risk, it changes the nature of the business. A pipeline company, for example, doesn't fail because demand disappears. Energy demand remains strong. The infrastructure works. The economics make sense. What destroys value is uncertainty over whether that infrastructure will be allowed to operate at all. When permits become reversible, when approvals become conditional, when long-term assets can be stranded by shifting political priorities. At that point, you're no longer evaluating an engineering project or a cash flow model. You're speculating on political outcomes. That's not investing, that's gambling, and I don't gamble. So the decision became clear. Not because the businesses deteriorated, not because management failed, but because the environment they operate in no longer met the standards required for long-term ownership. This is the part many people miss. When capital leaves, it's rarely loud. It doesn't announce itself with crashes or headlines. It leaves quietly. Projects are delayed. Expansion plans are shelved. Infrastructure investments are postponed. And those decisions ripple outward. You start seeing it in the data if you know where to look. Cross-border investment flows have begun to reverse. Canadian capital that once viewed the U.S. as the safest destination in the world is pulling back. Not fleeing, just hesitating. And hesitation, when it persists, becomes redirection. American investment into Canada isn't collapsing either. It's stagnating, waiting, watching. That's not a vote of confidence, that's a warning signal. Because when both sides stop committing, when capital on both ends chooses caution over expansion, growth slows. Quietly, persistently, and cumulatively. This is how economic partnerships unravel, not through confrontation, but through withdrawal. And once that process begins, it's very difficult to reverse. One of the hardest lessons I've learned over a lifetime in markets is this: capital doesn't wait for clarity. It moves before clarity arrives. By the time politicians acknowledge a problem publicly, capital has already adjusted its position. Not because investors are smarter than governments, but because markets are forward-looking by necessity. Businesses can't afford to wait for press conferences. Investors can't operate on hope. They operate on probabilities. And right now, the probability that U.S.-Canada trade relations return to their old level of stability in the near term is lower than it has been at any point in my career. That doesn't mean relations will collapse. It doesn't mean borders will close. It doesn't mean trade will stop. It means uncertainty has become persistent, and persistent uncertainty is poison to long-term investment. Here's something policymakers often underestimate. Once capital leaves, it doesn't come rushing back just because the rhetoric improves. Trust in economics behaves a lot like reputation in business. You can build it over decades, you can lose it in a year. And rebuilding it takes far longer than anyone expects. When companies delay building factories, pipelines, rail expansions, or logistics hubs, those decisions don't sit in a neutral state. They get replaced. If a Canadian firm decides not to expand in the United States, it doesn't simply wait forever, it looks elsewhere. Europe, Asia, domestic investment, alternative supply chains. Once those investments are made, they create new dependencies, new relationships, new efficiencies. The original opportunity doesn't return automatically. The same is true in reverse. American firms that hesitate to invest in Canada begin diversifying supply chains away from North America altogether. This isn't ideological, it's operational. Executives have a responsibility to shareholders, employees, and lenders. They can't justify committing billions of dollars to projects that depend on political goodwill rather than enforceable stability, and this is where the damage compounds. Slower investment leads to slower productivity growth. Slower productivity growth leads to weaker wage growth. Weaker wages reduce consumer demand. It's a feedback loop, one that doesn't make headlines but reshapes economies over time. What concerns me most is that the current policy approach seems to assume that economic relationships are easily reversible, that if things go too far, leaders can simply walk it back. History says otherwise. Once alternative trade routes are built, once supply chains are redesigned, once capital is deployed elsewhere, the old structure rarely returns in full. This is why long-term investors act early, not out of panic, but out of prudence. And this is why I acted when I did. Not because I expect catastrophe tomorrow, but because the direction of travel matters more than the destination in the short run. If you see a bridge slowly cracking, you don't wait for it to collapse before choosing another route. You reroute early. That's what responsible capital does. And the tragedy here is that none of this was inevitable. The U.S.-Canada economic relationship was one of the world's great success stories precisely because it was boring, predictable, professional, depoliticized. It allowed businesses to focus on efficiency instead of defense. What we're witnessing now is the slow politicization of that relationship, and capital, being indifferent to narratives, is responding accordingly. In my experience, once money starts behaving defensively, it takes years of consistent behavior to convince it otherwise. Not speeches, not promises, not election cycles, years. When people hear about trade disputes, tariffs, capital flows, it often sounds abstract. Numbers on a screen, headlines that come and go. But in the end, the cost never stays abstract. It lands on real people. It lands on workers whose factories don't get expanded, on communities that don't receive new infrastructure, on young families whose wages don't rise as fast as prices. That's how economic friction shows up in daily life, quietly, unevenly, and often without a single moment you can point to and say, this is when it happened. One of the great myths of modern politics is that trade conflict hurts foreigners first. In reality, it hurts domestic stability. When cross-border trade becomes less reliable, businesses respond conservatively. They slow hiring, they delay raises, they cancel projects that would have created long-term employment. And once those decisions are made, they don't get reversed just because tensions ease slightly. This is why I've always said that good trade policy isn't about being nice, it's about being predictable. Predictability is what allows businesses to plan 10, 20, 30 years ahead. And right now, predictability is what's missing. I want to be very clear about something. None of this means the United States is doomed. America has extraordinary strengths, deep capital markets, world-class universities, innovation that still leads the world. But strengths can be squandered if they're taken for granted. Economic leadership isn't something you declare. It's something you earn every day by behaving like a reliable partner. Canada understood that for decades, quietly, consistently, without drama. That's why the erosion of this relationship matters so much. Not because of any single tariff or dispute, but because it signals a broader willingness to trade long-term stability for short-term leverage. And leverage without trust doesn't compound, it decays. So can this still be fixed? Yes, but only under very specific conditions. First, policy must become boring again. That may sound strange, but boring policy is good policy. Clear rules, consistent enforcement, fewer surprises, less personalization of economic decisions. Second, agreements must be treated as commitments, not suggestions. When countries sign trade deals, they're not making political statements. They're creating planning frameworks for millions of private decisions. Undermining those frameworks has consequences that last far beyond any administration. Third, trust must be rebuilt through actions, not words. Capital doesn't respond to apologies. It responds to patterns. Years of consistent, predictable behavior are required to undo months of instability. And finally, there has to be an understanding that economic relationships are not zero-sum contests. The success of Canada does not weaken the United States. The success of the United States does not threaten Canada. For decades, the opposite was true. Their prosperity reinforced each other. That's the model that worked. And it's the model worth preserving. I didn't make my decision lightly. Exiting positions tied to U.S.-Canada trade was one of the more difficult calls I've made in recent years precisely because the underlying businesses were strong. But strong businesses can't overcome unstable frameworks. Capital can tolerate a lot: inefficiency, taxes, regulation, even mistakes. What it cannot tolerate for long is uncertainty without an endpoint. That's the lesson here. Not panic, not doom, but caution. History shows that economies don't usually break suddenly. They drift, they fray, they weaken at the seams long before anyone admits there's a problem. My hope is that this drift is recognized early enough to be corrected, because the cost of fixing it later will be far higher than the cost of fixing it now. And once trust fully leaves, it doesn't come back easily, no matter how much anyone wants it to.